My 401k is worth about half of what it was a year ago. Now, I know you can't tell us when the market is going to recover, but should I still continue to contribute to my 401k plan?
The answer to that question is absolutely. Just think about it this way. You're out buying groceries, and all of a sudden the price of milk or eggs or steak is cut in half. Is that a good thing for you or a bad thing? It's a good thing. These values are, the stock market may go lower, we just don't know that. But you have to continue investing when you're buying stocks at roughly half of the fundamental value that you were buying them at the high. Your emotions are leading you the wrong way. The time for you to get scared and get out was when you were so happy and optimistic when your 401k account had its previous double the value.
Truth, yeah.
So your emotions betray you. So I'm not trying to tell you, be very clear on this, that this is the time to jump into the stock market. But it is time, always time, to keep your plan going. And eventually you're going to want to add a little bonds to that, just because having a little dry powder can help keep you from making mistakes. So you might want to think about it, not in any rush, but gradually having a little bond position. You should probably have, I don't know, 10 or 15% in bonds. I don't know exactly, but think about a little bit of safety there in an appropriate way. Don't do anything, ever do anything in a hurry in the stock market.
What year?
10th grade.
A sophomore in high school, and she has a question concerning her age group.
Well, I'm really concerned about the future. With everything that's going on, can we ever trust Wall Street again?
The answer to that is, of course we can trust Wall Street again, but not the Wall Street we know today. People have lost their trust in Wall Street, and they are going to demand, these individual human beings who have been so badly hurt by the behavior of Wall Street, will demand a better Wall Street. They will demand, to refer to a previous conversation, a previous subject we touched on,
I love
they will
this
demand
answer.
that Wall Street behave as fiduciaries for your money and will invest your money the way you would invest it yourself and not the way they would do it with speculative risk. So trust can be restored, but there's an old saying, and it could never be more true than where we find ourselves right here this evening, and that is, trust is an awful lot easier to destroy than it is to create. Creating or restoring trust is a long-range proposition, and Wall Street was able to destroy it in a matter really of months, from the middle of 2007 to, say, September of 2008. Took a year and a quarter for that trust to be destroyed. And my own personal view is that what went wrong in this agency system I've described, and you recall it was an ownership society that is gone and is never going to return, to an agency society that's not serving the principals that it's supposed to serve, those fund shareholders, for example, to a new, what I call, fiduciary society. And that is a federal requirement. And I'm not a big believer in regulation, but I don't see any other way to do this. A federal requirement that all money managers observe traditional standards of fiduciary duty. A federal fiduciary standard for money managers, which says what? Simply put, it says, put the clients first. Don't charge those excessive fees. Participate in corporate governance and force those corporations out there to operate in the interest of their shareholders. Focus on the long term, we'll call that investing, and not on the short term, we'll call that speculation.
Got it.
And don't let big financial conglomerates come in here and own your management company, because those financial conglomerates, which own 2/3 of the mutual fund management companies, do you think, Pam, that those financial conglomerates buy a mutual fund company for $1 billion to earn a return on the capital of the mutual fund shareholders, or to earn a return on their own capital?
Right.
But that whole different set of stockholders. And that gets to, you can see this coming very clearly here. Here are the mutual fund shareholders, they're in the rumble seat, or should they serve the shareholders of the management company, this big conglomerate? And I think Matthew and Luke put it pretty well. No man can serve two masters. And so we've got to not allow these financial conglomerates to get into this money management field, and they could not do so if the rule was you can't serve two masters.
There has to be rules.
You have to choose.
There have to be.
Obviously, I'm a military member, and I currently contribute to my thrift savings plan. I was just wondering if there's any investments that I should just stay away from.
Now, the thrift savings plan is, for people who don't know, is just like a 401k for all federal employees and service members.
Well, first of all, I think I would be totally derelict in my duty if I didn't say thank you for your service to our country. We really depend on people like you, and I thank you really from the bottom of my heart for that. To get to your question, I really like the thrift saving plan. I've been familiar with it for a long time. I knew some of the executives down there. It's run at an even lower price than Vanguard is run, the ultimate accolade. I mean, I like that because I like competition. And
make a note on that.
their prime offering is an index fund, stock index fund, and they do offer a bond option. So yes, that's the right way to go. I mean, I would not, they got into, I think, real estate, you'd remember this or not, real estate funds a few years ago. I'm not just so keen on real estate, and of course this year real estate has blown up. So stick down the center. Stick with the stock index fund, stick with the bond index fund, balance them in the way that I've kind of suggested, and don't be tempted by, you know, the grass is not always greener on the other side of the fence. In this case, the grass is pretty terrible on the other side of the fence. So stay on the good side of the fence, Christine.
I'm divorced, and I've been using the services of a financial planner. But in the light of what's happened recently with the Madoff and the Stanford disasters, I wanted to know if I should still depend on my financial planner, or can I do it myself?
Well, I guess I'm tempted to quote former President Clinton, says it all depends on what the meaning of it is. Can you do it yourself? And the answer is yes, you can. If the it is a simple program, an asset allocation program diversified between stocks and bonds, you make sure it's very low cost and keep putting your money in. Don't peek is another. You don't need to look at the darn thing every day or every time that ghastly statement comes in, and just hang in there. That's what I've been doing since 1951. In July of 1951, my first job with Wellington Management Company, I was making $250 a month, and $37.50 went into my defined contribution pension plan there, and I've been doing it ever since then, 57 years. You would be amazed how much money is in that plan. I break my own rule once in a while. There's so much money in there that I peek every once in a while. If you're trying to beat the system, which I don't recommend, and you want to get into more exotic instruments, what we call alternative investments, maybe a little hedge fund here, some commodities there, trying to pick the latest hot manager, you can't do that by yourself. The big caveat here is I'm not sure there's an advisor that can do that with success. We actually have data done by some professors up at Harvard that show that investment advisors do a little bit worse than investors operating on their own. And that's before we take into account that the advisor takes usually something like 1% a year from your account.
Right.
So if you're comfortable doing that, if you're comfortable going the simple way, I think you can do it yourself.